This TFMR podcast is brought to you by your friends at JM Bullion. Visit jmbullion.com for all your gold and silver bullion needs. Welcome back to your TF Metals Report podcast highlights for the week of March 15th, 2021. We knew it was going to be a busy week. Interest rates were rising. The dollar was rising as well. And, of course, we had a midweek FOMC meeting and press conference from Chief Goon Powell. Somehow, though, we made it through the week with higher prices for both gold and silver. We began the week all the way back on Monday the 15th discussing the daily chart of COMEX Gold. This is one of those interesting chart patterns that I told you about. This, again, is that 60-minute candlestick chart of the last month in COMEX Gold. Remember, banging around the low 1800s, and then finally the bottom just dropped out at the end of the month. And we went all the way down below 1780, and then once that happened, we knew what was coming next. We went all the way down to 1680. But now over the last week or so, we've recovered. We're a good $50 off the lows as of this moment. And if you look at this, you can see where there's kind of a reverse head and shoulder here, where the first shoulder came in on the 3rd around 1700. Then you bottomed out at 1680 like we thought it might because, we were in that range from 1680 to 1780 for 100 days last year. So once we fell below 1780, you figured 1680 would be support, and it was. So then after getting to 1740 a couple days ago, we pulled back to 1700. And now here we go again. So the first thing we have to hope for is a move over 1740. Now, again, are you going to get that tomorrow? Doubtful. Again, unless bank trading desks are words getting out, man, and they don't want any part of being short metal ahead of whatever the Fed might announce. But I'd be surprised if we got there and sustained above there prior to Wednesday and something good coming on Wednesday. But nonetheless, you can kind of see on this 60-minute candlestick chart, you can see the importance of getting back above 1740, but really even 1750 because that's that peak back on the 1st of March. And then from there, we got it. Obviously, the level is 1780 for the obvious reason. Tuesday, March the 16th was just one day before that FOMC meeting concluded. And with little factors to move gold up and down, that's always a time period where the bank traders run the stops in both directions, squeezing the buy stops with a run to the upside, squeezing all the sell stops with a run to the downside. You see this a lot of times on U.S. market holidays and any other time where the trading volumes are light. That's what we saw on Tuesday. And that was a major talking point on Tuesday, March 16th. As we discussed yesterday, you can expect the banks to screw as many people as they can that are trading gold futures by spoofing price higher and setting off a bunch of buy stops from people that are short, and then by spoofing price back down to wipe all those people out, and then get a whole bunch of sell stops run from people that are long. And in the end, price finishes up where it began. I mentioned this yesterday. I said it's a lot like U.S. bank holidays, like a President's Day or a Martin Luther King Day or something like that, where price moves all over the place and then finishes up in the same, because they're just screwing with people because they can. And you saw it today. And if you're following along in the comments of the site, you saw the charts I posted. About 9:30, 10 o'clock this morning, suddenly gold spikes. Goes all the way up to 1740. 1740, really? That's as far as it went? How many times have we talked about 1740 being the next resistance over the last week? And it got to 1740 and 15 cents on a spike to the upside. There was no doubt a squeeze of the shorts. Squeeze them out. Oh, look at that. There's a whole bunch of them sitting there. Good till canceled stop orders on your short up there at 1738. Let's see if we can trip those. Yeah, that'll be fun. Let's do it. Then once you got to 1740, we don't want to go any farther than that. And so all of a sudden price immediately reverses and then goes all the way down to 1726. All the while, dollars not moving, bonds aren't moving. The banks are just screwing with people. And then I posted that chart. I said, look at this. Huh? Look at that. Now they run the stops the other way. And now watch what happens next. They'll probably go right back up to about 1730 and stop. And that's precisely where we are as I speak, with now the Globex closed for its customary hour, 1730, with that full range today, finishing the day basically unchanged. Wednesday, March 17th was, of course, St. Patrick's Day, but it was also that FOMC day where we got the Fed lines at 2 o'clock Eastern and Powell's press conference at 2:30. The metals actually responded positively to all of those news events, and we discussed silver later that day in our podcast. And then the short-term chart of silver. Again, we had this little pennant we were watching where we blasted through that. But you can see where 2660, or maybe just slightly below there, is a very important level, and that's the level that we got shoved backward. Clear bank action this afternoon. I mean, the dollar wasn't rallying at all, but yet silver got capped twice at 2660 and then shoved sharply lower, almost a full 1% lower, all the way back down to about 2635 before wrapping up at 2640. All right, well, if we're going to continue this, we got to stay above this blue trend line, which is down here now at 26. And we got to maybe come back down, ride the red arrow as support instead of resistance, and make a move through 2660, which will set us up for 27, hopefully. Silver on the daily chart, again, you can see this. Again, I didn't put the lines on here, but 27, support back in August and September, resistance in December and January, support almost through the whole month of February, and now it's going to be resistance again. Clearly, the 50-day moving average is an issue as well. Briefly above there today, but we didn't set off any sell stops, that's for sure. 2650 is where that will be. It's pretty flat here. 2650 will be the 50-day moving average for the front month May, really for the rest of this week. So that'll be the level to watch. If we can get above there, we can close above there, then we're, again, 2660 and 27 come into view. Any movement above 27 that we can hold sets us up for 28. We'll see. In the reaction to the Fed on Thursday, March the 18th, we were quick to notice that even though bonds had sold off sharply and the dollar had rallied, gold was actually hanging in there. And with rates at least 10 basis points higher on the 10-year note, gold was actually the same price it was the day before. This was a good sign, and it set us up for a strong close of the week on Friday. After the FOMC chose to do nothing regarding long-term interest rates on Wednesday, and once Chairman Powell had successfully dodged all questions about yield curve control, we were concerned that perhaps a sell-off in bonds might be coming, and that's exactly what happened overnight in the U.S. and Thursday morning in Europe, with the U.S. 10-year Treasury note spiking all the way to 1.75%. This, of course, heavily impacted the precious metals and drove them sharply lower. But the good news is, as of midday on Thursday, prices had recovered some. And gold was actually back to where it was when the FOMC statement was first released 24 hours earlier. This despite Treasury yields being a solid 10 basis points higher. Is this dip buying a sign that the low is in? Maybe. But with yields still rising, we've got a long ways to go before we can blow the all clear. We'll have to watch to see if perhaps a stock market collapse due to the higher interest rates will finally get the Fed to act. But for now, they seem very reluctant to discuss yield curve control. And until we get a top in nominal interest rates, gold will likely remain range-bound at best. And we did finish the week strong on Friday with both COMEX metals posting weekly gains. Part of the reason for that was our first instance of negative rates in the U.S. You might have missed this. After Powell spoke on Wednesday and did nothing, the 1-month Treasury bill briefly went negative on Thursday, and the 3-month Treasury bill almost traded negative on Friday with a low print of 0.00%. This is the first time we've seen negative rates in the U.S. Probably not going to be the last. What other macro stuff is going on? Well, your first chart of the day is the 3-month, the 90-day T-bill. Remember, we noticed yesterday after Powell that the 1-month T-bill traded negative 1 basis point yesterday, and then it recovered to get back up to 0 and like a half of a basis point. Well, today, for a while, the 90-day T-bill printed 0.0%. There was even a time, it was caught by Bloomberg, when the offer side, remember there's a bid and offer, and the offer is always higher? The offer was actually negative half of a basis point. Didn't trade there, at least not that I've seen, but it got there. So now here we are on the short end, negative yields. Remember Danielle DiMartino Booth telling me that in the Sprott Money thing last month? That the Fed is crowding out everybody on the short end? And then you got all this cash being goosed out of the Treasury finally in these stimulus payments. It's got to go somewhere. Well, let's stick it in the bank. We'll stick it in the money market fund because I don't know where to put it. Now all of a sudden there's all this extra demand on the short end and yields are going negative. More reason for the Fed to do this twist thing. Cut down on the short end, buy the long end, cap the long end. It's all coming. It's all coming. So that's a significant development today. That was your first chart. Again, look at this. This goes back to November. 3-month T-bill was actually had a yield, 8 basis points. Not much, but at least it was something. As you can see, closing today at 1, but intraday trading as low as 0.00%. Thanks for listening to this week's TF Metals Report podcast highlights. Hey, do me a favor. If you find this free service helpful, either on Spotify, iTunes, YouTube, wherever you listen to it, please give us a little bit of love. You maybe subscribe to our channel, give us a like. All of that will help us to spread the word. It takes time and energy to put these things together. Just give us a little love back, and we'll see if we can't keep going. You could also check out a subscription at TF Metals Report. It's only 50 cents a day, $15 a month. You can find more information at tfmetalsreport.com/subscribe. Again, thanks for listening. We'll have another one of these podcast summaries for you next week.